And we're live. Happy Wednesday, everyone, and welcome to the Mojo Show, where we talk everything real estate. I'm your host, Joe Mortgage.
And I'm Cup of Joe Mortgage.
This week's episode, we're busting another big mortgage myth out there, one we hear all the time. The best loan is always the one with the lowest interest rate. But is that actually true? Well, we're about to find out. But before we get to that, a little coffee talk between the Joes. Joe, I saw this a couple days ago, this debate online. I don't know if you'd seen it, but I want to pose it to you and anyone else out there, by the way, if you're listening in, I would love to hear your thoughts on this. Drop your comments down in the bottom there. Feel free, would love to. So here's what the debate was. Would you rather have unlimited airline tickets anywhere, I don't care where, unlimited, or free food at any restaurant for the rest of your life? So for the rest of your life, either airline tickets to anywhere you want, free, right? Or any restaurant you want anywhere in the world, free the rest of your life.
I mean, that's a good question. I know which way I'm leaning now, but if you would have asked me this question probably 10 years ago, I probably would have gone a different route.
Really?
But I would go airline tickets anywhere for, the rest of my life because I can eat anything I want, but that's not going to be something that's going to be a memory. And traveling, and right now with the kids growing up and Hunter about to graduate high school, you know how that feels. Samantha now at college, and I think the memories of trips would be more important to me than food would be.
Okay, all right. I think actually, it's a tough one. It really is, because I mean, to be able to jump on a plane and go wherever you want, whenever you want in the world. So there's a lot of places I haven't been, definitely. That would be pretty cool. Although I'm thinking the food.
Really?
I am to be able to just, I don't know what your food bill is every week, but I mean, with your son, a teenage boy, that's got to be pretty expensive, and
well, I will say during the last couple of weeks or the last month, my food bill has been cheaper because he's been watching what he's eating because he's got to stay under a certain weight for his powerlifting.
Yeah. Okay.
And so my food bill's been a little bit better, but for some reason he thinks good food also has to be the most expensive food. So, okay, so I'm gonna, what type of food? I mean, because the question is, restaurant for life. Is that just one restaurant?
No,
any or restaurant. Is it okay? Because I was just asking because the way the question reads, it says any restaurant for life. I didn't read the question all the way through. Okay, so any.
Right. So it
in
could
the
be
long run, it'd probably be better for the pocketbook to go with any restaurant. So that way, right, over the lifespan, I'm going to eat more than I'm probably going to fly.
Right. Because if you're going to fly somewhere, let's say that you fly to Australia. Well, you're going to have the money to be able to stay, right? And eat and everything. It's great to fly there, but your stay and accommodations and everything else, you're going to have money for, right?
Yeah. So you're going the other route. If you can have free food in any restaurant, you'd have the money to pay for the flights. I see where you're going. I went the other way. Okay.
But I mean, any restaurant, it could be Whataburger, Buc-ee's that you love so much, or it could be Ruth's Chris,
Okay, now you're getting crazy. You threw Buc-ee's in there as a restaurant. I think of that as a gas station with a lot of good food inside.
Right. So you'd be eating there, wouldn't you?
Yeah.
Right. Okay.
That's funny. That's funny. Well, that one was a good one. I was not expecting that coffee talk this morning. So I appreciate you coming up with a new way of us doing it. But I am going to ask our viewers, if any of you guys are out there, the two out there that are watching us, this weekend is a huge weekend for my son. I am going to bring this one up, Joe, before we get into this myth. So he has his state powerlifting meet here in Texas Saturday. I know he's excited, but anybody that prays or just thoughts of goodness, please send them his way. But I'm very excited for Hunter and see how he does this year at state. First time to qualify for state, so very proud of him.
It's amazing. Well, we'll definitely keep him in our thoughts and prayers that he does very, very well. And
he doesn't have to win it. I just want him to have a great meet for his own confidence. That's all I ask.
There you go.
But
good
I know today, Joe, we're getting into the myth of the lowest interest rate is the best interest rate. So we're going to start this a little different. I know last week you started me with true false questions and I made you answer them. I guess this week you're flipping it on me and I get to answer. So.
Yes. I want to ask you a few questions instead of you always asking me the drilling questions, and I want to flip it back onto you. So I'll throw a statement at you. You just tell me if it's true or false.
Okay. Right? And for our listeners, please put your answers in the comments if you're listening to these questions. Yes. Because I'd love to know what you're thinking.
Absolutely. Definitely. So, all right. So let's start with the APR, annual percentage rate. The APR is always the most accurate way to compare loans. True or false?
You know, everybody wants to say true on this one, in my opinion, just because they think that's the best way you can compare the fees based in the payments and things like that. That is false, in my opinion.
I agree.
The APR, you know, there's a bunch of different factors in there, and it could be discount points. It could be premiums being in there, other fees that are being charged that are not APR fees. So it does not always compare, you know, apples to apples or even oranges to apples, because you don't have the same information just because it's an APR. It's kind of like looking at a W-2. You might make income as a W-2, but a W-2, we can't look at that and be able to calculate and guarantee that we could get a loan done. So I look at the APR kind of like a W-2 when you're trying to calculate income.
I agree. Yeah, because the W-2 isn't going to be able to break down your overtime, for instance, right?
Right.
That's going to be in there. So yeah, totally agree with you on that. All right. So let's go with number 2 here. Paying mortgage points to lower your interest rate is always a good idea.
Man, I want that lowest interest rate, Joe. 3.5. You know, I mean, can we get there? Well, you know, the amount of points that it would take to get there doesn't make real sense. So I'm going to go with false on that one, because it's not always a good idea. Now, there are a lot of times they are great ideas, but you know, they're a mortgage professional like yourself and I. We're going to look at what is the total cost versus the savings,
right? And where's the break-even point of that?
Yeah, because it's not the one thing that people don't understand is with interest rates, and I know we'll get into this too, is the cost for the different rates is not consistent. It's not like, a half a point gets you a quarter off of your interest rate. It's not consistent like that. It jumps. Yes. And, you know, that's one thing I know we'll get into. But like you said, finding that break even. So I'm going to say that one is false. It's not always a good idea.
Agree. And I'm going to, I know we had talked yesterday a little bit about this before the show, you know, kind of test run that we love to do. But we were talking yesterday. I'm going to see if I can bring it up while we're talking here of what points look like of different interest rates, right? See if I can do a screen capture. So we'll get into this. But before I start jumping in, let me throw another little question here.
Oh, not done?
No, you are not done, sir. You're not out of the woods yet. I'll just do one more. Okay. Just one more. So my credit score determines my interest rate.
By itself?
Ooh.
The question's very vague, but is it just based on my credit score that determines my interest rate? That to me is false.
Okay.
But does your credit score influence the type of rate you can get? Yes. That's true. So it depends on how that question is going to be like directed, you know, at me. But if you're saying the credit score by itself determines the interest rate, that is false. There are other factors that come into it, but it does hurt. If you have a low credit score, it does hurt the type of interest rate you can get and the cost associated with that interest rate.
Right. Yep. Absolutely. Agree. Good stuff.
And I know we said we're going to do true false, but as you can tell, I always had to tell a teacher a little bit more about why this is true or why this is false.
Yes, exactly. It's not just a one-word answer. You got to give the details of it, right?
If you have a mortgage loan officer that's giving you one-word answers, then you need to go to somebody else, because there are so many different things to explain in our industry. So,
indeed.
All right, Joe. So I'm going to flip it back for a second.
Okay.
What is another, in that last one, right? What is another factor that can that, along with your credit score, determines rates? Just one more, because there's a bunch of them. But
there is a bunch more. There's a whole list of them. Matter of fact, I think I did for a seminar last year. I think I listed out about 23 or 24 different factors, right? But I'll just pick on one, and that's a loan to value ratio.
Yep.
Right. So if you're at a 95%, 90, 80%, 70% loan to value, there's different tiers or different buckets, if you will, of pricing for each one of those. Right. So yeah, that can definitely determine things for you.
Yeah. And that's one thing that we're going to have to get into is, that's another myth that we probably need to talk about. Is it always better interest rates if you put 20% down versus 10% down or 5% down?
Right.
So, yeah. And I apologize, guys, if I'm having internet issues or some lagging today. I am working from the house this morning, so the internet's not always the best. So I apologize if that is happening. I know that'll throw off some of the show. So,
well, we'll let it slide this time, Joe. So let's start busting this myth here of the best loan is always the one with the lowest interest rate, right? Let's jump into this, because on the surface, this does sound good. I mean, it's logical, right? Who wouldn't want the lowest rate possible? But here's where people get tripped up, right? Because the lowest interest rate doesn't always mean better deal. There are other key factors: closing costs, loan terms, and whether you're paying points to buy down the interest rate and so on. So let's talk a little bit about buying the points, because that's really where this gets into. You and I have both seen, especially in the past couple of years, builders out there are giving these, 3.99, 4.99 or whatever, 4.95% interest rates. How are they doing that? Well, because they're charging. And I just had this last week. Had a client that was giving them, I think, a 5.25, I think, or something like that, or a flat 5% interest rate. They were charging them $15,000 in points.
Yep.
$15,000 in points. And it showed it right on the loan estimate, right? 15,000. And this is where, the shiny things look nice, right? But is that the best use of that $15,000?
So that's where I'm seeing a bunch of builders, lenders, or, and let me say it this way. I'm seeing this outside of like the builders that own their own mortgage company. These are more builders preferred lenders.
Yeah.
The builder's giving you $20,000. I had this one about a year ago. Builder was giving them $20,000 in incentives just towards closing costs and prepaids.
Mm-hmm.
Well, that builder's lender, preferred lender, was charging, I think it was $17,000 in discount points to get an interest rate that was about a 3/4 of a point better than the rate that I could give without the points.
Mm-hmm.
And so what I showed the client on that one was, okay, you're using this to buy down this interest rate, but we're still in a higher interest rate market.
Mm-hmm.
And so in that low interest rate that you're getting in this market, well, in a year or 2 years, we might be able to refinance that down. Well, you just wasted, $17,000 of the 20 grand they're giving you
Yep.
when you refinance that interest rate. Now if they're giving you a 3.99, like I know DR Horton out there, and I'm going to say the name, people are going to be like, why'd you say the name? It's a good builder, and they have ways to make it work. And I tell my clients, hey, that I can't touch that because they're not charging you the points and they're still giving you that rate. But these preferred lenders, on the one that I did, I showed my client, I had him bring in $9,000 less to the table. So I showed him where that $9,000 over the next 2 years is a better savings than that interest rate that he's getting and the cost of it.
Yes.
So, we kind of went back and forth on that because that shiny thing, like you talked about already on here, was that interest rate. That 5.25, that 5.5 versus my 6.25 or my 6.5. Why is it better to look at that higher rate? Well, there's a couple of reasons in my mind. One, you get to write off, if you itemize your taxes, you get to write off all the interest that you pay on a loan, on a mortgage, right? Yep. So I was showing him over the next couple of years that payment's not that much bigger, but he also gets that benefit of writing it off a little bit more. And then I also showed him on discount points, those you can't always write them off all as one, right? Now you need to talk to a tax person, and one day we're going to have a tax person on here.
Yeah.
But you can't write that $17,000 off. You have to divide that out over multiple years. So I was just showing them how we could do it, and it made sense there. Now there are some builder lenders that I can't make sense of, and I tell my clients, structure it this way so you're less out of pocket. Maybe don't just take the lowest rate because they're trying to charge you a bunch of points.
Right. But sometimes you can balance it out. Again, you and I, we just have to run the numbers, balance it out as far as using some of that as more of, towards your closing costs and paying some of it, or maybe using more towards a down payment, so to speak, and then balancing it with points on the interest rate, right? Just kind of, get the where it's financially best position for the client.
Yep. Well, and another thing that I've started doing too is looking at these. If the builder's lender is not talking to you about temporary rate buy downs with that money, then again, they're doing a disservice, because we can use, like I have one right now that the builder is giving $10,000. We're using just under 2,500 of that for a 1.0 buy down. So I'm qualifying them with the rate with no discount points. And I'm going FHA. So on this one, I think I'm at 6.625 without any discount points based on this client. Well, their first year of payments at a 5.625.
There you go.
And I'm still using 7,500 of that to offset closing costs.
There you go. Wow.
So, looking at these things is the best way to do it. And it's not about the lowest interest rate for qualifying. It's about where is that break even on the cost for that rate or that credit for that rate, because that's one thing that we can do too. And I know, Joe, we talked about that yesterday also.
So I'm going to try to just instead of just talking about this, let's see if I can pull up some numbers so we can actually visually see it instead of just talking about it. And then we can break this down. I'm going to see if I can work the buttons here. Let's see.
I'm going to stop the ticker.
Okay. File, image file. Let me see. Nope, I don't want that.
So while Joe's pulling this up, what I think he's pulling up here is going to be kind of what we see when it comes to rates and the cost for those rates. Is that what you're pulling up, Joe?
Yes, but I just did a snippet of one, right? So let's see. Let me see if I can do this.
There it is.
Here we go. Okay.
Perfect.
All right. So with this, here's the way that, and whenever I pre-approve a client, I don't know about you, Joe, I think you kind of do the same thing. I show them all of this live, right?
Yep.
With whatever loan that we're, qualifying them with. And I go through because granted, we have over 20 different lenders that we work with, and showing them, because each lender is going to have different cost for different rates. Okay. They just are, right? This lender, though, in looking at it, 7.375. This is going to get you as close as we can to a par rate, meaning 0 points. And I've only seen 0 points on an interest rate, I think 3 times in my career, right? So it's very low. There's always points to an interest rate. This is 0.038%, right?
Right.
That you can see here. So what we mean by that is that 0.038% of your loan amount. Okay. This loan amount happened to be, I'm trying to think, 90% of $500,000 is
Well, you want me to do the math on that? Is that what you're
why
saying?
don't I have that? Why don't I have that, Joe?
You said what, 90% of $500,000?
$500,000, yes.
So $450,000 loan amount.
There we go, 450. So on a $450,000 loan amount, if you multiplied it by the 0.038%, it would come out to $171 that you're seeing right here.
Right.
Okay. Now, there are over here to the right, this column here, this is showing at that interest rate and the loan amount of $450,000. This is your principal and interest payment each month, just the principal and interest, right? We're not talking homeowners and, escrow of homeowners insurance and property taxes, just the principal and interest each month. So the way that I explain it to people is this: if it's going to take you to go to a lower interest rate, 7.25% compared to 7.35%, what's the cost? What's the cost difference? Now, this is just going to be just under $1,000. Matter of fact, if I 171, so it's $934 additional cost to go to a 7.25%. Well, how much are you saving? You're saving, if you look at the principal and interest, you're saving $38. So you're spending $934 to save $38 a month. Well, take that $38 a month savings, divide it into the additional cost of $934. And it tells me it would take you 24, almost 25 months to break even. Yep. Now, to me, that is a good investment. It's less than 3 years. Less than 3 years. I like a 3-year break-even point or less personally, because statistically, over 80% of us Americans, we do one of two things every 5 to 7 years. We either sell our house and buy another one, or we take our current mortgage and we refinance it every 5 to 7 years statistically. So to me, to be able to have a break even of 3 years or less, that's going to give you a couple of years of benefit, right? Of that, in this case, $38 a month savings. So that, to me, it's under 3 years. I mean, it's really just barely over 2 years, 2 years and a month, right? I think that's a great investment. But when you jump from the 7.25 to the 7.125, this is a bad investment. That's costing you $2,000 more for $38 a month savings. That's a bad investment.
So I'm gonna throw a spin on this real quick, Joe. You're not gonna like it, but I'm gonna do it. So one of the things that we've talked about is the temporary rate buy downs, right? I just talked about I'm doing a 1.0 buy down for a client. So for our viewers, one thing to think about, if you look at that 7.625 interest rate.
Yeah.
Right? So we're giving back $3,300 towards cost. Well, a 1.0 buy down is the difference from that 7.625 payment, the $3,185, and the 6.625 payment of $2,881. Okay. So for a temporary rate buy down, we set aside the difference of that payment in an escrow so people know what that is. Well, that cost is $3,648. So that what I'm showing here is you could take that higher interest rate and have that whole 1.0 buy down paid for almost with that 7.625, but for the first year. So you're betting on the market. So I do this for clients that are really questioning, hey, my payment, I need to try to stay this in a budget, because we can always come back and look at refinancing to drop that rate.
Yes. This is a great.
In this case, I would be able to pay for that buy down, all but $300 of it, by going with that higher rate. But your first payment would be based on that 6.625.
Yeah, that's a great.
Showing this over video, right, is a lot
Mhm.
easier to explain. Where that's why I do Zoom calls for all my clients when I do
Same here.
pre-approvals, because we talk about these options and I show it.
Yep.
There's another screen that I show it, but if I just tell you this information over the phone, it's going to confuse you,
Yeah,
because
absolutely.
it confuses me, and I'm in the industry.
But
Right.
and talk a little bit about this to take what you said, because some people don't know this, that points, there's positive points and there's negative points. Can you talk to that a little bit, Joe, the difference?
Yeah. So what I was getting on this is, if I wanted to do that 6.625 rate for you, right,
Mhm.
it's going to cost $8,000 to get that. Now that is over 30 years.
Mhm.
But that $8,000 in a savings from, a par rate, which is that
Mhm.
7.375 to there,
Yep.
that $8,000, that's over a 5-year break even. It does not make sense, because in the next 5 years, we're hoping the rates get back down into the fives. But the reason that, the negative part about this on these points is, if I'm paying 8,000 to get that rate and I go to refinance, that $8,000 is gone.
Yeah, exactly.
And so that's a negative to me if I'm not
Mhm.
going to be able to stay in that rate for at least 7 years or more.
Right.
Okay.
Right.
And so in this case, doing that temporary rate buy down to get to a lower rate, you could even do it based off the 7.375. I just didn't have the difference, so I couldn't show it here. But so the part I'm talking about on the temporary rate buy down is, if you don't use up all of that $3,600 that it costs for that first year, let's say in 7 months the rates get down and we can refinance, whatever has not been used up on that temporary rate buy down comes off your principal balance,
Right.
versus discount points just disappear.
They
So that
disappear.
you paid that up front.
Mhm.
So that's where, in my opinion, looking at other ways that versus just buying the rate down on discount is a better understanding of the temporary rate buy down.
Agree. And you can balance these out, right? Put a little towards buying the interest rate down, and then
Mhm.
put a little towards like a 1-0 buy down or a 2-1 buy down. Because there's different ones. There's a 3-2-1 buy down, right? There's a 1-0 buy down, a 2-1 buy down. So using it towards a temporary buy down, and this that we're showing the numbers here, a permanent buy down,
Yeah.
right? That's the
Yeah.
difference between the two. So and please understand, those of you that are looking to purchase a home anytime soon or later this year, when we see these points here and the cost of those, that is a one-time cost. That it becomes a part of your closing costs. So the positive points here, that becomes a part of your closing cost for that interest rate that you'll end up buying it down towards. These negative numbers, that's the lender paying you, right, to take that a little bit higher rate, and that is paid to you as a part of the closing as a lender credit, right?
Yep.
So you are either paying for the rate, or the lender is paying you for it's just a positive, negative, points is what we're talking about here.
Yeah.
And
And I went a different route on the positive negatives, but
oh,
the premium pricing are those negative numbers.
yep,
I use those, Joe, kind of for those clients that maybe they don't have as much assets
right,
as what
for
we need.
yeah,
Utilizing the higher rate to get those is good.
mhm,
When you're looking at an FHA loan and
mhm,
you want to come back and refinance that, there is a streamlined refinance on
yeah,
FHA where you cannot roll in those closing costs. So, what we look for is, does it make sense to have a interest rate that's maybe a little higher than what par is, but helps offset those closing costs on FHA streamline?
mhm,
We're really looking, not in this one here, because I know this is a conventional priced loan,
mhm,
just because you can tell by the rates. But what we look at is there any premium pricing that's still dropping your interest rate, but helping offset those closing costs?
right,
So those are the ways. And right now, the reason that investors are not doing big premiums, because before, when you had things like this, you would see bigger premiums on these rates
mhm,
that are higher, the negative numbers. The
yes,
reason right now that a lot of investors are not doing big premiums is because they know we're in a high rate market, and they make their money off of the longevity of you making payments
mhm,
and the interest rates over long term.
mhm,
Where if they just give a bunch of premium pricing, and let's say that we did let's say the 7.625 was paying back 2 points.
Okay.
Well, if we did that,
That's
right?
like $1,000.
I know, but I'm just saying if that was there, because that has happened in the past, right?
Mm-hmm. Mm-hmm.
Back when the refinance boom was going, you were seeing a lot of things like that because they were betting on those lower interest rates, maybe going up. So then that way they could make the money off those little bit higher rates because they're not going to refinance them right away.
Mm-hmm.
Well, it's the opposite right now. If you take that higher interest rate, they're betting on the market going the other way. So they would lose money if they give a bigger premium when the market changes and we start seeing those rates in the lower sixes. And, that's why they're not giving the premium pricing as much as they used to.
Can I divert us just for a minute on one other thing? Okay. So, because I know we're actually running out of time. There's so much to talk about with this. There is. And this is why, having the lowest interest rate is not always in your best interest, right? Because, think about it. You are taking that money and you are investing it, right? Just like you in your 401k in the stock market, you're investing that money in your home. So use it in the best financial means possible to get the best payback. And in that, two things I want to point out. First of all, if you're going to buy down your interest rate, to make it simple, what Joe and I are saying, how long are you going to stay in that home? Is it only 2-3 years? Is it 10 years? How long are you going to stay in that home? Because however much you buy down the interest rate, if you're only going to stay in that home 2-3 years, it may not be the best right investment to make. Right now, here's the one thing I wanted to divert on, and that's PMI. Because granted, the lowest interest rates people love, but every lender, and I want to pull this up actually. Let me see if I can get rid of that. And I'm going to show this. Every lender, believe it or not, folks, every lender has different costs of PMI, right?
Well, and different types of loans have different costs per PMI.
Right. Yes, right? Exactly.
So what Joe's talking about is on this one, he's talking strictly conventional. Every lender has different PMI because they're using different private mortgage insurance companies. Mm-hmm. So that's what PMI is private mortgage insurance company. And then with like FHA, it's not private mortgage insurance, but it is mortgage insurance because that one's set by what FHA and HUD have set out there. And that's consistent across the board. Yeah. And that is not based off of credit. I know, Joe, that this was part of the topic today too. So while Joe's got this up here and we're about to go into it, FHA is a consistent mortgage insurance across the board, no matter your credit, no matter, how your debt to income ratio is. Mm-hmm. Those are consistent. With private mortgage insurance, they're going to look at where's your credit score? What mm-hmm. kind of debt to income ratio do we have? They're going to look at that. Your LTV, which your LTV also on FHA for a little bit, but that's a different topic.
Basically 0.55% on FHA. Right?
Yeah, but I'm going to let Joe go into this real quick because this is a great one.
This lender here, it may have, the lower, I don't know, they got a 7.375. I can scroll down here and get to higher, like 7.5% interest rate. But look at this, $79 a month for PMI right here, $79 a month. Up here, the lower interest rate, it was charging $143 a month for PMI. So is the lower interest rate always the best rate? No, it's not. It's not. Right. You've got to be able to look at the details and go through them. If you need help with that, reach out to Joe or I. We can, whatever loan estimate you have from lender, builder, whatever, we can go over that with you, right? To be able to break it down so that you can make sense of it and know what is going to put you in the best financial position for the home that you're buying.
Yep.
Right. Because different PMI, just because you have a lower interest rate, your PMI may be $50 a month higher. Right. So always look at the details. We'll help you go through that. I know we're over time. We're about 5 minutes over. So
I honestly thought today we were going to be struggling to keep this topic going.
Really? No.
This is when we started, but then I looked down, it's 9:30.
Right? Yes, absolutely. So what's the main takeaway here, folks? Let's wrap this up with the main. You have to look at the full picture, not just the interest rate, right? The best loan is the one that aligns with your long-term financial goals, monthly budget, and overall costs. That's what it comes down to, not just the rate itself, not just the APR. Okay. There's more to it than just an APR. In fact, let me stop this one here, flip us back. Again, if you have additional questions, if you are in the middle of putting an offer in and you're getting a loan estimate, give us, reach out to us. You see our emails down there below. We'd be more than happy to review it with you, to let you know. Maybe, go back to the lender and ask them for this, right? Ask them these questions, right? We can help you with that. So hopefully that's been a bit of a eye opener for everyone today on interest rates. Hopefully it'll educate you, as we always are striving to do, Joe and I, with everyone. If you have questions, let us know. Let's talk about next week, Joe. So next week we're going to continue on with our series of busting mortgage myths, because there's just so many of them out there that really need to be explained in detail for everyone to help you out in purchasing a home or refinancing. So tune in next week at our usual time, Wednesday, 9 a.m. Central, 8 a.m. Eastern, as we cut through all the noise and bust more myths commonly heard out there. The one that we're going to focus on next week: banks are the best place to get a mortgage.
I'm looking forward to this one because I've worked in the banking field too. So I'm looking forward to this one.
Thank you to everyone who tuned in. We really appreciate. Oh, you know what? Did you notice that we had some comments, Joe?
No. Oh, I did not. Oh.
Jeremy.
Oh.
I do apologize. Let's hold off here before we close things out. Jeremy, we definitely want to recognize this is good. Is the PMI included in APR, Joe?
Yes, it is. And that's why you cannot you cannot compare loan to loan just because of APR, because PMI is included in there when it comes to calculating that APR based on the way that, the regulations make us do it.
Awesome.
So, and Jeremy, thank you for listening in. Jeremy is actually right outside of Kansas City, Missouri. I think he lives in Lee Summit, Missouri, or Independence, Missouri. He's my cousin. Funny thing is he came down and he was an intern for Nash and I when we ran LHM for a whole year. He came down and it was going towards his business degree. He was our intern for I think it was just for about 6 months.
Oh, wow.
Yeah.
Well, thank you, Jeremy. I appreciate you tuning in, and everyone else, that other person that is. The questions, really do. If you know of anyone who might be able to glean from what we've covered here today, or if you want to catch up on any of our past episodes, go to our YouTube channel at the Mojo Show Real Estate Podcast. And while you're there, hit the subscribe button, because we are on a mission to get to 1,000 subscribers. And every like, comment, share helps us reach more home buyers just like you. So before we close out, any last words or nuggets of advice for our listeners, Joe?
No, thank you guys for tuning in. And like Joe said, go check out our YouTube channel and subscribe to it, because we are trying to get to that 1,000 users. We're not quite there, but let's get to 100 first. And I would love to have that before May. So please go and subscribe to our YouTube channel.
Excellent. I'm Joe Mortgage, and that handsome guy there with the beard is Cup of Joe Mortgage, and we'll see you next week.
Mr.